Let's jump right into this explainer and unpack exactly what EI Power Berhad is and why, honestly, retail investors are absolutely buzzing about its upcoming IPO. If you've been tracking the massive infrastructure build-out happening across Southeast Asia lately, you've probably heard the hype. But what exactly is EI Power? Today, we're going to pop the hood. We'll explore their revenue model, what's driving their incredible growth, and why Malaysia's booming data center market is basically acting as a massive tailwind for them. So, whether you're a complete beginner or a retail investor doing some serious due diligence before the listing, this explainer is designed to give you the clear, hard facts.
To make sense of all this excitement, we'll follow a pretty straightforward agenda. We're starting with the macro trends. Then we'll break down their actual business model and a massive financial pivot they just made. After that, we'll unpack the IPO mechanics and finally, weigh the bull and bear cases.
All right, part 1, the data center megatrend. So the numbers we're dealing with here are just staggering. Major tech players, the hyperscalers, are literally pouring billions into Malaysian data centers. We're talking 10.5 billion ringgit from Microsoft, 2 billion USD from Google, and a massive 29.2 billion ringgit planned from AWS through 2038. This is creating a localized gold rush, especially down in the Johor region, where recently there were 42 data center construction projects approved. This isn't just a flash in the pan, it's a massive multi-year structural build-out.
Now, how exactly does EI Power fit into all this capital sloshing around? Well, you've probably heard the phrase, picks and shovels play. It goes back to the 1849 gold rush. The folks who made the most reliable fortunes weren't actually the ones panning for gold. They were the ones selling the picks, the shovels, and the jeans. EI Power operates exactly like that. They aren't building the data centers or leasing out server space. Instead, they provide the absolutely essential infrastructure that makes this digital gold rush possible in the first place.
Which brings us to part 2. What EI Power actually does. So technically speaking, EI Power is an EPC specialist. That stands for Engineer, Procure, Construct, and Commission. But what does that mean on the ground? On the mission-critical side, they design and install the heavy-duty power systems. Think massive diesel backup generators and complex fuel distribution networks for industrial buildings like data centers. Their entire job is to ensure these hyper-sensitive facilities never ever lose power. They even run these incredibly complex integrated blackout simulations just to guarantee 100% uptime.
There's a great quote from the analyst notes that really hammers home the core investment thesis here. It says, EIP provides the essential power infrastructure that every data center must have, regardless of who owns it. And that's the beauty of it. It doesn't matter if Microsoft, Google, or AWS ultimately wins the cloud computing war. Why? Because every single one of those operators needs incredibly robust, mission-critical power infrastructure. EI Power gets to ride the wave of the overall build-out without having to place a risky bet on just one tech giant.
Moving on to part 3, the massive financial pivot.
This is where things get really interesting. Just 4 years ago, back in financial year 2022, EI Power was a pretty traditional, highly diversified power engineering firm. Conventional commercial and industrial work made up half of their revenue. Renewable energy like solar PV took up about 28%, and that mission-critical data center work, it was actually their smallest segment, bringing in just 21% of their roughly 39.5 million ringgit in total revenue.
But fast forward to Q1 of financial year 2026 and, wow, they have essentially reinvented themselves into a pure-play data center specialist. A massive 98% of their revenue is now coming from this high-margin, mission-critical segment. They clearly saw the gold rush coming and completely realigned their entire business to serve it. And the financial impact has been phenomenal. If you annualize their Q1 revenue, it points to a run rate that easily crushes their entire FY 2025 performance.
And backing up that aggressive growth trajectory is a seriously impressive 99.9 million ringgit unbilled order book. So, as an investor, why does that matter to you? Well, it means they aren't just coasting on past success. They have really strong earnings visibility straight through to 2027. They've got major projects lined up, like the 37 million ringgit Nilai 2 pipeline, where the contracts are already signed, sealed, and just waiting to be built.
All right, part 4. The IPO details explained. Let's get into the hard numbers for a second. They are listing on the ACE market of Bursa Malaysia on the 21st of May 2026. The issue price is set at 48 sen, or RM 0.48 per share. Now, a crucial detail from their prospectus is how they plan to actually use these funds. Out of the fresh capital raised, 24.9 million ringgit is going straight into working capital. And honestly, that's absolutely vital for a company that needs to front the cash to procure massive industrial generators for these huge capital-intensive contracts.
However, and this is a big however for retail investors, you absolutely have to understand the dilution at play here. The total share count is expanding massively, jumping from roughly 133.1 million shares pre-IPO to about 700 million shares post-IPO. The key takeaway? At 48 cents, you're paying a premium for their future growth trajectory and the broader data center boom, not buying into some deep value bargain bin multiple. The pie is getting a lot bigger for sure, but it's also being sliced into many, many more pieces. Which leads us perfectly into part 5, the bull versus bear case.
Let's objectively weigh their biggest flex against their biggest vulnerability. On one hand, EI Power has carved out a dominant 66.7% market share in the Kool-Aid district. They literally built the power infrastructure for 4 of the 6 operational data centers there. And Kool-Aid is basically the absolute epicenter of Johar's whole build-out. But on the flip side, there's a glaring concentration risk. A whopping 49.5% of their FY 2025 revenue came from a single client, CCIE Engineering.
Let's expand on those bearish risks for a second. That heavy reliance on one client is what analysts call a single point of failure risk. If that relationship goes south for any reason, it's going to hit their earnings hard and fast. We already touched on the share dilution, which obviously dampens immediate earnings per share. And then there's the international angle. A big piece of their future growth story relies on expanding into Thailand, where 36 new data center projects just got the green light. But here's the catch. EI Power doesn't have a track record there. No licenses, no established relationships. It's a completely unproven, risky new frontier for them.
But hey, let's look at the bullish side of the coin. They have incredible, highly specialized technical skills. Doing integrated blackout simulations for Tier 4 data centers isn't something your average contractor can just wake up and do. The barriers to entry are intensely high. Plus, while they do have that one massive client, they also have fantastic loyalty across the board. 17 of their 29 clients last year were repeat customers, and we absolutely cannot ignore their profitability. In Q1 of 2026, they posted a record-breaking gross margin of 47.2%, which is way above their historical averages.
Which brings us to the ultimate question for the future of this stock. I'm going to leave you with this final provocative thought to chew on as you do your own due diligence. Can EI Power actually sustain those incredible 47.2% margins as their new permanent baseline now that they're a highly specialized pure play operator? Or was Q1 just a lucky anomaly driven by a specific highly profitable mix of projects? Because honestly, if they can hold those margins, this growth story is nothing short of phenomenal. But if they regress back to their historical average of around 38 to 40%, well, the valuation math changes entirely. Thanks so much for joining me for this explainer. Keep learning, keep analyzing. I'll catch you in the next